Well, that was the Central Bank Governor Godwin Emefiele taking questions from members of the press after the MPC decision announcement. And of course, the Monetary Policy Committee decided to leave the monetary policy rate at 14%, cash reserve ratio at 22.5%, liquidity ratio 30%, and asymmetric corridor at plus 200 and minus 500 basis points around the MPC. That's keeping all the monetary policy variables unchanged. Well, I still have here with me my panel of discussants, Chioke, and of course Dr. Biodun Adedipe and Mr. Muda Yusuf. Well, I guess for those of you that are advocate of easing, were you surprised at what you heard? Now, considering what he said was their consideration, looking at the global economy, the risks and the outlook, the global economy. And of course, yes, Nigeria has really attained some kind of growth, but it's still fragile. They are still trying to consolidate. So would you have expected anything more than this?
Well, I expected something different. And that, again, comes from what I said earlier on, that if you look, for example, at the current plan Nigeria is executing, we call it Economic Recovery and Growth Plan. We have established recovery. Yes, you may say it is fragile, but I will also say that it's gone a little above fragile, in the sense that when we had 0.5, I revised now to 0.72, it was just one positive against the background of 5 negatives. But now we have 2 consistent positives, and in fact the second is 1.4%. That, in fact, by international standards, is quite remarkable, that 1.4%. But for us, of course, given where we are coming from, and as the governor rightly mentioned, of course, a population growth rate of about, he said 3%, but it's about 2.6% actually, so annual growth rate of the population. Now we need more than double that in order to ensure that we grow inclusively. But a lot more work needs to be done. And that is where I differ a little, that I believe that monetary policy should be forward-looking and not wait to react to what fiscal operations are. Of course, the 3 of them must work together, as I rightly said, monetary, fiscal, trade, policy makers. But the key thing here is that why can't monetary policy provide leadership rather than wait to react to what other policymakers are doing? But the most important thing I see in all of this is working further, like my colleague has said earlier on, to improve the business environment. And that is deepening the reforms that eases doing business, and also we trigger and even go to the extent of providing incentives for private capital, because that is the way to go. So, and I think one of the ways to go is to give that indication that we want to ease monetary policy. If it is not done now, I would have expected an indication that that might likely come first quarter of 2018.
Okay. Now, I, as an investment expert, what would this decision mean for investment inflow, for the market, the financial markets generally?
I think people would take it constructively. I think we had expected them to hold all the rates, or the monetary policy rates, and I'm glad they did what they did. Like my colleague just said, the recovery we are seeing is still quite fragile. And from the CBN's point of view, trying to ease, signaling more sort of so overtly that you want to ease, may have the negative consequence of, people pulling back. You also have to put our situation in the global context. Already systemic central banks, sort of Bank of England, the US Fed, European Central Bank, they're already normalizing their interest rate environment. So if we then go ahead and ease, we can end up being in much more trouble, as the money will just fly out of Nigeria and go back to the developed market. So we've got to be more constructive and allow the effect of the reduced interest rate environment we are seeing already in the T-bill market to continue. From the Eurobond issuance they just did, there's more cash coming in that the government will not need to borrow from the domestic banking system. And that is helpful because then that frees up potential liquidity for the real sector. Now, they've only just done $3 billion out of a target of 5.5, and assuming that they will conclude the balance of the 2.5 in the near term, then that further reinforces the argument that you just leave rates as they are and let this signal effect that we are moving out of the domestic, the short end of the yield curve. We're not going to be out there buying up, issuing T-bills every day. You banks, you need to find who to create risk assets for. That means you have to come to the real sector and come in. I think there was a question about, losing the structural bottlenecks to actually lending